Hello, and welcome to the Northstar Global Flexible Fund Quarter 1 update. I'm Marang Morudu, and I'm joined by Donovan Stefan, Head of Research here at Northstar. Glad to have you here.
Thanks, it's great to be here.
So Donovan, entering 2026, global markets came into the year with strong expectations on returns, but Q1 has been a strong reminder of how quickly that can change, just given the tensions in the Middle East, as well as a lot of the narrative around AI and software. From the perspective of the fund, how has the fund performed over the last quarter, and what have been the key drivers of that?
Thanks, Marang. Yeah, I would say what I've learned is that the market can always surprise you. Having gone through what we did in 2025 with all the kind of market volatility and into what's happened in 2026, you remain surprised. So I think in the first quarter of 2026, markets were driven by a combination of geopolitics and shifting expectations, particularly around monetary policy and inflation and parts of technology. So, obviously we know that the Iran conflict escalated towards the end of February, and that led to the biggest shock to oil supply in history. And we saw that borne out in the oil price going up over 70% in the quarter. And the effects of this were quite broad-based and swift. What we saw in the month of March is we saw the dollar strengthening, we saw developed markets outperforming emerging markets, and we saw equity returns globally being driven by the US market. And this is in complete contrast to what we saw in January and February and throughout 2025. Simultaneously, while this was going on, monetary easing, which was expected in 2026, was being priced out the market, and that was expected to be a tailwind to equities. There's even fears now of potential rate hikes because of inflation spiraling out of control. So if we just look at the equity market level overall, what we have seen in the quarter is really an extremely narrow leadership of market performance. And that is evident by 80% of positive market returns in the quarter being driven by three sectors, that being energy, materials, and utilities. And other sectors either underperformed or delivered negative returns. So in that context, it's been a challenging environment for ourselves because these are not typically businesses we invest in. We are focused in high quality companies, and those are companies that generate strong free cash flow and high returns on capital. And that was not being rewarded in the quarter.
Yeah, and that focus on high quality companies is a key consideration in that context. But with this context in mind, in the discussions that you're having in your regular meetings, what are the key topics of discussion that are sort of driving your views on returns going forward?
Yeah, so that's a good question. Obviously top-down factors are important to consider, things like geopolitics, monetary policy, and inflation. But here at Northstar, we're primarily focused on bottom-up approach because we feel that's the part where we can have more control out of the outcomes than macro. So what we have seen actually quite interesting in the quarter is that there's been an immense level of market dislocation. And that's really borne out where we've seen returns have been driven by extremes. So either extremely cheap companies trading at below 15 times P multiple and 10 times have performed positively, or extremely expensive companies, those at above 45 times or 40 times multiple, have delivered positive returns. And that really is not where we see like our portfolio. Our portfolio is more high quality business trading at reasonable valuations, and that part of the market has been left behind. On top of that, what we've seen in the market is that companies with very low returns on capital have outperformed companies with high returns on capital. And that's the complete opposite of what you would expect over the long term. And I think this degree of quality underperformance is driven by there was a lot of crowding, and this is unwound in quite a disorderly fashion. But what I think is important to note is that we see this as not a shift, a permanent shift, but actually a cyclical phase. Just like many other factors, value, momentum, and growth, they all go through periods of underperformance. And just like us, other global quality managers have experienced similar outcomes in this quarter. But I think what's even more important is when we dig a little bit deeper and we look at our portfolio and introspectively, we see that the businesses we own have strong fundamentals and are actually improving, and the gap between what we deem them worth to what the market is currently pricing them has widened, which has actually created great opportunities with which for us to deploy capital.
Another key point that you mentioned there, focusing on the fundamentals through these times. But just in line with this thinking, How would you describe the fund's positioning at the moment in terms of being able to capture some of the opportunities you're seeing?
Yeah, it's a great question. So a key driver of positioning is valuation. And here at Northstar, we have a global team that covers equities, we have a fixed income team, and we have a property team. And each of those teams provide us with an intrinsic value discount, bottom up. And what we saw in the quarter really is the intrinsic value discount of our global equity buy list. It's widened quite a lot to over 30%. And when it gets to those levels, it tends to be very attractive opportunities. So how did we respond to that? What we did is we increased our equity exposure and we allocated it to companies that we deem to be of high quality that were trading at attractive prices. So it created a great opportunity for us. At the same time, although we took advantage of this opportunity, we also remained aware of the risks that are potentially out there. So we maintained a reasonable portion to fixed income and cash throughout this dynamic. And that obviously helped us to be more resilient through the drawdown, as well as have dry powder to take advantage of when markets give you these opportunities. And I think, going forward, we are aware of the risks in the market, particularly around the geopolitics and the oil shock. But what's important to note about this is these shocks historically have tended to be transitory. And it's actually created great long-term opportunities to buy non-energy related assets that have secular tailwinds at these moments, and that is what we've been focused on.
So you touch on quite a bit a lot on the process and maintaining discipline. So just as a takeaway for investors, especially on a long-term view, what do you think remains most important for them to focus on, especially investing long-term in the Global Flexible Fund?
So what I think is important for investors to really focus on is one, process and time horizon. So the advantage of a flexible fund, it allows you to allocate capital across different asset classes based on risk and return. And to do that within a bottom-up, fundamental, disciplined approach is really important. And I think, in the short term, the markets can feel uncomfortable, but that's just part of the journey. I think what really drives returns in the long term is owning high-quality companies at reasonable valuations, allocating capital with discipline, and then the time part, allowing those things to play out and compound. I also just like to add, the way we manage a fund is we don't manage it for quarters, because that can be riddled with short-term noise. We focus on years and decades. And I think it's important to remind ourselves and clients is that the market is never as good as it seems at the top, nor is it as bad as it feels at the bottom. And I think opportunities like these give you the ability to invest capital for the long term to generate great risk-adjusted returns for our clients.
Excellent way to wrap it up, Donovan. Thank you very much.
Thanks, Marang.
Thank you very much to you. We will see you in the next quarter.